Welcome guys to Professor's Opinion. And on this video, I want to talk about the gold market and what's upcoming for the gold market, right? So, the may the rally in the gold market began ever since the COVID pandemic happened, right, in 2020. And yeah, the rally has been continuing for the last 5 years ever since then. But I'm not going to waste too much time getting into the details of what might happen and why I think that might happen. I'll just give you guys the basics of how the market actually works and why it's completely overvalued. And a correction is the base case scenario, and a crash is the second best case scenario or second most likely case scenario. And I'll explain why. So first of all, gold has no utility other than the money you get from selling it, if that makes sense. You don't get any interest to hold a gold. The only utility a gold has in your portfolio or in the central bank's portfolio is its value. It's ever increasing value. Okay. And the job of any central bank reserve around the world is to increase the value of the reserve. And so they saw this massive currency printing in the last 5 years. They bought the gold. They wanted to increase their reserve value, and they did that. Now, if gold price goes through a minor correction, at the current price, you have 4,000, $4,200. It's crazy, right? Crazy prices. Um, it's at these prices, the central banks and many low retail customers, the smart thing to do would be to sell. Okay. Buying is not an option at these prices because you're more likely to see a correction than a continuous bull run from these prices. So the option is to hold or sell. Well, if you hold the golds that you bought in the last 5 years as a central bank and the prices start going down, then what is the point in buying this gold? If you can't sell them at higher price and extract the value, then it's just sitting on your portfolio as a mark to market. You know, you it's not the profit is not realized, to put it simply. Okay, it's not been transacted. So my humble opinion is the central banks will start dumping their gold because you have to understand why central banks. Well, yeah, the first thing is they want to increase their central bank portfolio value, which they did by buying up the gold cheaply in the last 5 years and driving up the prices. And then these driving up of prices are attracting retail customers to buy and sell gold, more to sell than to buy, right, at these prices. So you have the downward selling pressure from the retail customers at these prices. And then you have the instinctive, I would say, technocratic, strategic approach of central banks around the world to sell some of the gold they bought in the last 5 years to realize those profits. Because otherwise, if the gold market crashes, then what's the point in buying all this gold if you can't even realize the profit? Because you're not getting any interest by holding this gold. There's no other value than the value you get by selling it. Well, yeah, if you get any value, if you make profit. So the downward pressures are from all directions. Inflation is ticking up in a lot of countries. Yeah, it came down in the last few years in Western countries, but now it's picking up again as it should because of all the macroeconomic and other factors. So yes, the Western countries did a few interest rate cuts here and there, but nothing has been aggressive and nothing, a rebound of interest rate hike is not out of the table. It's actually the best case scenario for a lot of major analysts in the next few years. So you have a lot of downward pressure on the gold price coming up in next year. That's just my take on it because you have to understand, as a central bank, you buy that gold, you're most likely buying it in an international spot market. You're most likely buying it using pound or dollars. You're expending your central bank dollar or pound or euro reserves, most likely dollar reserves, to buy this gold. Okay. And now you bring the gold home and then you sell it. Okay. You sell it to the retailers in your country. Okay. You sell it to the middle class, the upper rich of your countries. And those retail and middle class and upper rich people are going to buy that gold at the current high price. And as the central bank of the country, you net the difference. The price you bought it at dollar and the price you sell it in your own country's currency in the local market. And the difference is your profit as a central bank. Well, what's the fundamental goal of any central bank? Would you want to increase your portfolio value or make profits of this gold speculation or arbitrage, whatever you call it? What's the benefit of the central bank? Well, the fundamental goal of any central bank is to make their currency increase in value in the long run and make it a more legitimate currency to trade in around the world. Well, the easiest way to increase your currency's value is to do more gold transactions in that currency, if that makes sense. Okay. So if I'm a small country like Bangladesh, if my central bank, let's say India, okay, let's forget small countries. Let's talk about India. India's central bank bought a massive amount of gold in the last few years, and now they're slowly selling it and they're pausing their future buy uh, positions. And they're selling it into the local market, the gold they bought, and they're selling them in Indian rupee. And the idea is here quite simple. If you have more gold, right, chasing the same basket of rupees, that's just gonna make the rupee more stronger as a currency to trade in the long run, right? So what countries are now realizing is their domestic gold market is gonna be the major factor in determining whether their currency becomes a globally recognized currency to trade in the future. That's what China is doing. That's what USA did in the 1930s, 20s, 40s, you name it. They worked to establish a solid, liquid, and trustworthy domestic gold market system. And that's the reason behind, for example, India's RBI purchasing and then repatriating all the gold reserves from abroad back to into their own country, into India. Because they want to dump some of these gold at high prices into the local market, bring in more liquidity, more market structure into the local domestic gold market. And that's happening. That's happening right now as we speak. And all smart economies, all major economies and major players around the world are doing the same thing. I mean, except the Western world. I mean, well, the Western world, it's a different case scenario because they already have such a strong currency. Buying gold as a central bank and then dumping it into the local market to boost their own currency is not going to work for them because their currency is already so strong. So this model only works for currencies that are pretty weak or not even in the moderate mid-level tiers. And so yeah, you'll see a lot of emerging markets, a lot of these middle developed countries like China, Russia buying up and dumping this gold into the local market. And it's a win-win because you end up with your middle classes owning more gold, which is a long-term good hedge. And you end up with a stronger currency because now you have more of the gold chasing that currency. Just because, yeah. So, and that is also one of the reasons why you have Middle Eastern gold markets so established, private gold markets, and Middle Eastern currencies are so strong. It's because of that established local domestic gold market. And now you have other major players like India, China trying to do the same thing in their own currency, in their own country. And yeah, that's basically what's going on. So I personally expect at least a mild correction in gold, 25% in the next year. I wouldn't be surprised if there's a major crash, inflation picks up in the Western world, interest rates hikes, more banks decide to dump more dollars buying up gold, and you know, I wouldn't. I mean, sorry, the last part I misspoke. So inflation picks up in the Western world, interest rates spike in the Western world, And now you want to hold more of those currencies of the Western world, not the currencies, but the bonds, because now they have better real rates. And yeah, so that situation seems to be the base case going forward. I mean, inflation is already picking up in Western countries right now as we speak. That plus the Eastern and the global South establishing this domestic gold markets and then selling the central bank gold reserves at high prices in these domestic gold markets to realize their profits before gold price going down. Those are two downward strong pressure on the gold prices coming up for the next year. And so I wouldn't be surprised if there's a big crash in the gold market next year. Yeah, the higher they go, the harder they fall, you know. And yeah, it's been true for any financial instrument, and especially for gold. I mean, you don't have to look too far behind. 90s, 70s, 80s, that's 40 years back, one generation back. I mean, you can look at the gold prices went to 800 dollars an ounce, and then it dropped within the next 2 months or within the next 1 year into $200 an ounce. That's like a 65% decrease within 1 year. And that can easily happen. So we can easily see gold prices going from 4,000-ish an ounce right now to, I don't know, 2,500, even 2,000. I wouldn't be surprised if they go down all the way to 1,500, $1,200 an ounce. That can easily happen as all the central banks want to realize their profits, dump these golds into the local markets um, for the global south, and the Western world decides to hike up the interest rate, making their bonds better investment than their gold. And yeah, so I can see a gold price crash coming pretty soon. And if I was a customer, I probably would be selling some of my gold to realize some gains from these historic highs, but I wouldn't be buying any gold, that's for sure, anytime soon. So yeah, that's it for mine. I'll see you guys in another video. Yeah.